This is Steve Wilkes, the Wagner Law Group in our San Francisco office. Welcome to today's webinar. Appreciate your attendance and look forward to having a good session and trying to stick to roughly to our 30-minute requirement. Today we're going to continue a little trend that I've had recently. For those of you that know us at the firm, many of you interact with us kind of on a ERISA retirement plan basis, but we do a lot of Investment Advisor Act, FINRA, securities, kind of related work to our retirement plan services and products practice, and I wanted to continue with that theme and talk a little more about some of the securities law side, if you will, on issues that we all address in that retirement plan world. Now today, what I thought I would do is a couple of things. I thought I would talk about private equity funds, a little bit about mutual fund asset allocation programs, and then some FINRA rules, or a reminder about some FINRA rules that are going to be effective in about another 6 weeks. And again, the reason we're doing that and doing this really from an SEC perspective is because so many of you have questions for us on the SEC or FINRA side from time to time, and it's the investment management aspect of our practice is very important. Now these particular topics, why did I choose these topics for today? I think on the private equity side, I chose that because we do get a lot of questions from plan sponsors. Should I do a non-traditional asset class of investment? How do I look at a hedge fund or private equity fund or venture capital fund? Similarly, we have advisors who are either doing due diligence of these funds on behalf of a client, or perhaps they are actually advising such a fund. So there's a lot more to these than knowing, understanding the investment metrics or the potential returns. And it's a pretty big topic, so I listed it as a part one for today. I think on the next webinar, or maybe the one after that, we'll follow up with some additional aspects of it, depending on your feedback. And then kind of the same thing on the mutual fund asset allocation programs or mutual fund RAT programs. Again, we're seeing more and more of our advisor clients and dual registered, broker-dealer clients kind of, sponsoring these, offering these, or doing the due diligence for them. And similarly, plan sponsor clients are asking questions about what to really look for. So again, there are things to look behind the scenes in terms of structure to be aware of, which go beyond the investment metrics. So I thought that might be interesting. And finally, there are some FINRA supervision rules that are coming up that were proposed and consolidated about a year ago. They were in the works for a couple of years. They're coming up on December 1. It seemed like a good time to remind everyone, especially our dual registered listeners, to make sure that the compliance department is up and on top of these issues. Okay, so that's kind of how we got to where we're going. So private equity, what is a private equity fund? I mean, the term can be used very loosely, and we talk about hedge funds, private equity, venture capital, so on and so forth. But generally speaking, for purposes of today, private equity, I'm using that in a way to describe, kind of a very actively managed pooled investment vehicle. It's probably going to have, it will have non-publicly traded securities in it for the most part, and it's usually the investment is usually meant to cover a defined period of time, maybe 7 to 10 years, or maybe some extensions. These private equity funds are usually limited partnerships geared for sophisticated investors and institutional investors, to make a capital commitment to fund investments for the life of the fund. And these kind of funds tend to be categorized as, they either are involved with buyouts or venture capital. The hedging is a different kind of private fund that's more of affecting different investment strategies through derivatives or other products. But we're talking a little more about the operating funds, the active funds today anyway, because we've seen a lot of them recently. The venture funds tend to go with young emerging companies with the hope that someday they'll be bought out by someone, or the exit strategies of public offering. Buyout funds are looking for majority positions or significant blocks of influence in a company, mature companies, and a lot of times those are leveraged up with some debt. and they're going to be concerned with the, they're looking at companies that have good cash flows that can service the debt, as compared to, what you're looking for in a venture fund. Anyway, there's a lot of issues, regardless of what kind of fund you have. These funds are subject to a host of issues under the securities laws. You have ERISA considerations with benefit plan investors. You have tax, just general business law, contract law. In the hedging world, you might have some special considerations or regulatory issues under the commodity rules and things like that. So what I thought I want to do is, before I talk about some of the structure, because I think it's important that if you're doing the due diligence for a fund as a sponsor or an advisor on behalf of a client, or you're actually, managing one, you need to understand the structure things. But I wanted to talk for a few minutes, just based on some of our experiences recently, about where's the SEC with, with private funds and private equity and all that stuff. What's going on? So, clearly, there's a lot of the assets are growing. It's getting pretty big. The last survey I saw a report that was dated as of, I think, July 30th, 2013. It put private equity assets that are under management at about 3.5 trillion. That's with a T. And at the same time, more and more firms, advisory firms, have had to register with the SEC to work with these funds, or they might have fit under an exemption before. So, inside the world of the SEC, and particularly where we see it is through the Office of Compliance, Inspections, and Examinations, there's a lot of interest in these funds, and I want to share with you some of the things that I think they're doing, they're looking for, because that kind of gives us a roadmap for how to deal with them. Clearly, the SEC has stated that of about 12,000 registered investment advisors, they think that somewhere north of 10% of them are advising at least one private equity fund. And that's not necessarily, and that could be different than hedge fund. I'm talking just about private equity here. And they started a couple of years ago something called the President's Exam Initiative as a way to kind of deal with the private equity industry. And they've gone out and really looked hard at some private equity funds, in the field, and met with industry groups to really try to understand what's happening. And of course, according to the SEC, their view is not to catch people and get them in trouble. Their view is to identify issues and have them resolved before the trouble emerges. In other words, they're problem solvers, and they want all their actions to be prophylactic and protective and for the benefit, rather than just catch the bad guys. They've done a couple of hundred. They've done about 200 exams, as I'm aware of from looking at their website and talking with our contacts at the SEC. And I think the feedback of what we can learn from that would be as follows. I think that they are looking at identifying, risk areas and where the priorities ought to be, and what they want to do is, for them, they want to look at the incentives that are existent in the private equity world, and then use those incentives and the trends around them to see where you end up with compliance failures. And in the private equity world, there are some risks and issues that are not necessarily present in the more traditional world, where advisors are buying and selling retail products or publicly traded securities. Traditionally, a buy-side advisor, they buy shares in a public company, and the advisor can vote proxies and maybe talk to the board up to a certain point, but their ability to really influence the company is pretty constrained. Private equity is totally different. These private equity advisors are using funds to get a controlling interest or a significant block of influence in a non-public company. And with this, you get this, that's a lot of control. And when you think about the relative lack of regulation of closely held companies as compared to the public marketplace, there's a lot that could go on in that world. An equity advisor could instruct someone to hire a certain advisor, an affiliate, use third parties, provide certain services, pay certain fees, and really kind of do it without a lot of review. And that sometimes leads to conflicts, which ultimately, from the SEC point of view, are an issue for the investor. I think one of the main things they focus on are, they're just looking at the general as limited partnerships. And, private fund promoters always talk about the fact that these limited partnerships are very heavily negotiated and a lot of protections are in there. But what the SEC is finding, at least the way they describe it, is that it's kind of gray. That the agreements, in their view, are very broad in terms of the type of fees that can be charged to the portfolio companies as compared to the advisor itself. And they don't think there's a lot of good disclosure around there. They're also concerned about, the lack of very clearly defined valuation processes or investment strategies, a process or a procedure for conflicts in how they allocate investments. And they also are concerned that limited partners at the end of the day don't really have enough ability to really follow not so much the status of their investments in an economic sense, but what's happening at the managing partner level. What's actually happening in terms of the operations. And so this is a big concern to the SEC and the kind of thing they're looking for. They claim there's a lack of transparency, that's been around for a long time, and that even though you do a certain amount of due diligence before you invest, they feel like once the money is in, there's not a lot of investor oversight. And, that could be because investors just trust the people, or they just generally take a hands-off approach, but they're concerned about it. I think they also see and have noted, just trends in the industry that put pressure on private equity firms, because even though capital raising is better now than it was from the big shakeouts back in 2008 and 9, there's still a lot of consolidation going on, and that creates a bunch of issues. The SEC they claim that they're concerned and they're on the lookout for what they call zombie advisors. That's their term, not mine. And those are managers that are unable to raise more money, so they continue to manage their existing fund long past, their useful life in terms of the investment strategy, if you will, just to keep milking fees out of it, to put it in plain English. And they're on the lookout for that, because they know that managers, have an incentive to profit from the portfolio and maybe even increase their fees or shift expenses around. So these are the kind of things that they're looking for, and that I think that the complexity and the growth have generated governance issues that need to be addressed as these firms grow. They cite the example that a lot of the growth in private equity doesn't come from traditional commingled vehicles, but from separate accounts and side-by-side co-investments. And the thing is, these accounts, which invest side-by-side, are not often allocated, don't always get the same deal expenses that are associated with generating, the deal flow. And they're just not sure that the compliance function is keeping up with the growth of the funds. And they've also seen, even though there's a lot of alpha, the potential for a lot of alpha returns out there, they're also concerned about what they call the compression of returns and convergence of returns. So, fewer managers are able to overcome or are able to hit their preferred return and collect their carried interest, and that heightens the risk that managers make up that shortfall by collecting additional fees or shifting expenses. I don't think they're painting everyone bad or saying that the world is totally evil. These are just some things they're concerned about and that they occasionally see out there. So they're on the lookout for it, and it's incumbent upon us to understand it when we're dealing in the private fund world. So I think that they're definitely very focused on expenses, and they think that's where a lot of the weaknesses in controls and processes are. Inadequate policies and procedures or inadequate disclosure around expenses. And they're also concerned about the fees and expenses that are, that are involved with using third-party consultants. Because out there in the private equity world and the hedge fund world, these might be known as operating partners or joint venture partners or what have you, but that's really just nomenclature. Advertisers promote themselves as providing all these consulting services and expertise, but it turns out that some of this stuff is really subcontracted out. They're really not. They're not employees. They're kind of getting paid. They're getting paid extra fees, but it appears as though they're just employees of the management company. So there's a little bit of weak disclosure around that. And investors, they think everyone's part of the, the full team of the advisor, and they don't realize in effect that they're paying for them as an add-on or incidental cost. And that's a big problem. Another thing that they're concerned about is a trend to shift expenses from the advisor more to the portfolio company or to the client during the middle of a fund's life without adequate disclosure, at least to the limited partners. And this is a problem that they're focusing on. And I guess so the flip side, I guess, of expense shifting is just, is inadequate disclosure. We all know that under the Advisor Act, disclosure is the key. I mean, it's all about disclosure. And there's a concern. I've come across some instances where, fees aren't adequately disclosed. Like, there's one fee that's known as a monitoring fee. And, monitoring fees are typically charged to the portfolio in exchange for the advisor providing board services and what have you. But what happens with limited partners, or what limited partners might not know, is that some advisors have caused their portfolio companies to sign agreements that obligate them to pay fees for 10 years or longer, even though the life of the investment might only be geared for 5 to 7. So we see some conflicts there, and they start accelerating fees. And, undisclosed administrative fees, hiring third-party service providers of, to quote the SEC, quote, questionable value. So these are the kind of things they're really looking at. There's been some enforcement activity over the last couple of years as a result of this private equity initiative out in the market. So I know that they are doing some things on it. And I think the final thing that, I would say is that they're very much concerned about valuation. And, there's a lot of discussion about whether you have an interim valuation. And, the industry has always said that because management fees aren't based on interim values, the role of interim value is limited. But there's a lot of disagreement about that. And sometimes there's also a kind of a change of valuation methodology. In other words, the offering memo might talk about one method, but in reality, another methodology is used. And there's been cases. There was a case settled in New York last year, for major dollars on that very fact, and they found that the manager had disseminated reports and marketing materials and all kinds of stuff that were just based on the wrong valuation methodology. And the difference between the stated methodology and what was actually used was, I can't remember the numbers, but it was very significant. So that's a big issue for them. Cherry picking, adding back numbers that just don't make sense from an accounting perspective to EBITDA. No disclosure about a change if you do want to have a change. So anyway, these are the kind of things that that they're looking for in the private placement world. And so when we're advising clients on investing in one, or we're advising one ourselves, or doing the due diligence on one, these are that we need to really look at a lot of these issues in the private funds, I believe, in order to do a good job and be aware that the SEC, I just gave you a little outline of some of the things that the SEC is looking at. Now, let me just, for those of you, just a refresher for those of you that already know this, and for those of you that maybe don't know that much about private funds, I'll just very quickly roll through a couple of things about private funds, just a couple of high points. I think basically, these funds are structured as a pool of money, and they're managed by by a team of investment professionals, sometimes with through a general partner or a separate management company, and they're typically offered only to very sophisticated investors, and that might include public and corporate employee benefit plans. And that's why the SEC feels that the little man is involved, because the quote-unquote little man has a lot of investment in these has a stake in these large institutional funds, like the teachers or state pension plans and what have you. They're typically funded, through private placements, and the management company just plays a host of activities and they earn a management fee, typically 1 to 2%. There are different formulas for these fees. There are things known as step-down fees, step-up fees, phase-out fees, all kinds of structures, as you can imagine. But the point is that a team is brought in with knowledge. A venture capital team, it might require a certain kind of expertise for an industry as compared to a buyout fund, which has a certain expertise for more mature companies, as compared to hedge funds, which is a lot more just trading strategy and investment methodology. And they really take an active role in handling the investments and then managing the underlying companies as well. The money, the money that is generated can be divided in a lot of different ways. A lot of this is tax driven, because of partnership tax laws or pass-through entity tax laws. But generally speaking, general partners get a carried interest, or the management gets a carried interest. It's usually 20%. That's kind of the norm. Though there are some, and there's a lot of tax rules that apply to the ability to defer these carried interests or not. It's been the subject of a lot of discussion over the last couple of years. I think the form of these things, you're going to see these as either limited partnerships or as LLCs. I think on a partnership basis, the tax issues, no federal tax at the fund level. If you're a retirement plan coming in, then obviously you're not as concerned about that. But you do want to be thinking about whether or not there's any debt-financed income on there that might generate unrelated business taxable income, or whether the fund is deemed to be operating a business to the point where it generates UBTI. So you want to be looking for those kind of things. A lot of plans, invest coming through a group trust because they don't want to file tax returns. So they'll come in through a group trust. To get around the reporting, but even so, they still have to pay tax on any UBTI. There's some special issues for offshore vehicles, and then of course the partnership form has certain limited liability rules, which are desirable from a contractual liability exposure point of view. The other form, limited liability company, is kind of a hybrid. Has some pass-through benefits on the tax side. It's taxed as a partnership. Most states recognize it. Liability is governed, under the appropriate state law in ways slightly different from a partnership. It just depends on the deal you're looking at. I think I might have done this in one of my prior webinars, but obviously the ERISA issues, especially for this audience today here at the Wagner Law Group, are really, really important. If you end up with a fund that's deemed to hold plan assets, you could be subject to the various ERISA requirements. Fiduciary duty rules, self-dealing and prohibited transactions, certain reporting and disclosure requirements. There are limits on incentive fees. There's one set of rules that apply under the Advisors Act. There's another set of rules that apply under ERISA on performance comp or incentive fees. There could be bonding requirements, different kind of liability provisions. So that's something that you really want to be aware of when you're investing. Are you in a plan that is maintaining its status as a non-plan asset fund or as a plan asset fund? Because the consequences are going to be different either way. Finally, there's a lot of different ways these things are delivered, and these interests in these funds are securities. So you have to be thinking about the securities law, and SEC registration really comes in two ways. You get the issuance of the interests in the fund itself involves securities, and it also comes into play at the level of the portfolio companies, where the private equity fund is going to invest in a company, and that's also going to issue stock or some evidence of indebtedness to the fund, and that could be subject to the Securities Act as well. So you have to make sure that you're in compliance with the federal securities laws and any applicable state securities laws. There are some offerings that are preempted from state registration or are exempt, and you just need to understand that when you're working with these funds, going through it. You want to see the right representations in the offering documents, or you want to structure it properly if you're on that side of the table. Typically, just very quickly, the main exemption here is under the Securities Act, Section 4A2, and that applies where you don't have anything that, quote, involves public offering. And the rules for exactly what that means are way beyond the pale here, but that's one exemption that's pretty common. Then there's a bunch of safe harbor exemptions under Regulation D, and you've probably heard about them before. You know, there's certain numbers of investors that are cut off. You could have accredited investors. You have some changes recently under the Jobs Act that create some new exemptions. It could be a single state offering. It could be an offering that only goes to employees of a certain company. So there are different ways to structure around these, and everyone needs to maintain pretty good awareness and knowledge about those. So that's it on private funds. So very complex from a regulatory point of view, lots of opportunity, some trends to be aware of. Let me talk for a moment about another program I wanted to talk about, the mutual fund wrap programs. And I wanted to mention those again because we're just seeing more and more and more and more of them all the time. Our advisors are getting more involved with exercising discretion and judgment and putting together programs. Plan sponsors are seeing these and being asked to make choices. So I'm going to speed up a little bit here too, so I don't overload you time-wise. But basically, there's a lot of mutual fund wrap programs out there, and a client will invest in a basket of mutual funds that are selected by an advisor, and then there's a single fee for the advice and any transaction charges. It's the way they work. Wrap fee programs generally include bundles of services, including, again, securities execution, advice, the selection of other advisors, custody, reporting, and all for a single fee. And even though the client might elect on its own typically to participate in the program or maybe advised by someone else, the discretionary authority is given to the advisor to change the investments within the wrap program as the advisor deems appropriate. And the SEC has special rules around a specialized kind of brochure, ADV for wrap fee clients. Those have been around for a long time. But I'm talking today about something a little bit different that we see a lot of, and that's a mutual fund wrap program, because the difference between a traditional wrap program and a mutual fund program is that in a mutual fund program, the advisor selects a basket of funds, if you will, rather than selecting other advisors that are going to mirror, separate strategies that are used by the unaffiliated advisor. And these are sometimes known in the industry as mutual fund asset allocation programs. They typically meet the definition of a wrap fee program, which you find in the Form ADV instructions. And these are geared a little more retail, a little more for the masses, if you will, and might have a lower investment minimum. They have couple layers of fees on them. The advisor sponsoring the program is going to get an advisory fee, and that fee might be shared with a broker-dealer that solicits clients, and the underlying investment manager, charges a separate fee. In the case of a mutual fund program, the underlying funds are going to charge a separate fee in addition to the fund expenses. And these funds are sold and offered in different ways. An advisor might invest client assets directly, or might use intermediaries, broker-dealer, fund complex, bank. But in a mutual fund program, the fund manager doesn't, kind of know the investor in the wrap fee program, and the entity selling the wrap fee program typically has the client relationship. Sometimes they get 12B1 fees or shareholder servicing fees for that, and that creates a potential conflict that you need to watch for. I think these programs, if they're structured properly and executed properly, can provide a couple of important benefits. First of all, you have investment professionals that are, using research and analysis. These are well thought out in terms of selecting the funds and monitoring performance, and that's always a good thing. And even if that's subcontracted away, it's the manager as the fiduciary that has the ultimate responsibility for that stuff. You just get economy of scale when you have a wrap program with a basket of funds. you're making something available that many investors wouldn't be able to do on their own because they don't have the asset, they don't have the minimum investment size. So there's an economy of scale there that's really helpful. And typically also these programs, will get an institutional class of shares at lower expenses that otherwise aren't available to the investor. So, and also I think a lot of these wrap fee programs also have an automatic rebalance provision. There's been some enforcement provisions on that as well. They might do that quarterly, and that mitigates style drift, which is a good thing. And again, when these wrap programs say that they're going to rebalance and they don't, there's been SEC enforcement activity on that particular point. That's something that they look for. In terms of an advisor's obligations, always a fiduciary first and foremost. Under the Advisors Act, nothing that operates as a nothing that operates as a fraud on the client's duty to disclose everything. And I think the biggest thing though to be aware of is to make sure they don't trip up on Rule 3A4 and somehow become a mutual fund without knowing it. In other words, a wrap fee program has to provide some level of individualized advice, the way they describe it under Rule 3A4 of the Investment Company Act. And the SEC has gone out and enforced this. I think the classic case was Clark Lanson back in, God, it was about 20 years ago. But basically they said that the advisor was operating a mutual fund asset allocation program and that it failed to register properly. So that's the kind of thing that you want to be looking for. There are a lot of conflicts you can get in these wrap programs. If you have for example, if you have discretionary authority and you have the ability to choose between a proprietary fund and a non-proprietary fund, that's an issue. You might be able to get affiliates involved, and there are ways to disclose around that or to fit within various ERISA exemptions to make it work, but there's a lot there. And I think, again, remember that typically typically the SEC has said that mutual fund wrap fee programs don't have to deliver the Appendix 1 to ADV Part 2A, but there's a couple of ins and outs around that, which sometimes you may have to, even though you don't think you have to, or you could even as an option. So I would think that there's some disclosure issues there to think about as well. And I would just say that of all the enforcement actions I've seen in this area, I think the two triggers that I've seen most frequently, one has been the failure to select funds in a manner consistent with the methodology that was disclosed to the clients and misleading disclosures about the program. That was one. And the other one was that the failure to rebalance. That was a case from, I think, from Boston, from New England a couple of years ago. And they didn't do the rebalance properly. That was the issue there. FINRA Supervisory, just really quickly here. These rules are coming, for those of you that are dual registered. Just a reminder, earlier this year, there was a consolidation of supervisory rules. They're going to become effective on December 1. Have you done it? Is your compliance up to speed? Are you ready to go? Basically, these consolidated rules kept the essentials of the supervisory system in place, but there's been a couple of distinctions, and I think that the main distinction is probably the inclusion of certain FINRA presumptions as to what constitutes an effective supervisory structure. It used to be that FINRA really didn't say too much or really care to tell you how you should structure your compliance as long as it was reasonable and it was effective. But I think now FINRA is saying they are providing a couple of specific presumptions as to what reasonably designed supervision is or is not, and that's something to think about. Some of the topics that came up in Regulatory Notice 14-10, that's where the consolidation was posted. Conflict of interest. The new rule deals with probably two examples that might impact your supervisory structure. First of all, it says that it requires that a firm have procedures that prohibit associated persons who perform a supervisory function from supervising their own activities and reporting to or having their compensation or continued employment determined by a person or persons they're supervising. Aha. So a firm that can't comply with this requirement now has to show the factors that you use to reach this determination and how your how your arrangement works around it and otherwise complies with the rule. And the other main area is that it now requires firms have to have procedures that prevent a firm's supervisory system from being compromised by an associate person's position at the firm, the revenue that person generates, or any compensation the associated person conducting the supervision may derive from the associated person being supervised. So they're kind of looking at who's managing who and who's supervising who in a different way now. Oh, there's some changes on OSJ. They leave the definition the same, but the way they write it now is that it might require firms to review the manner in which they assign supervisory principles to the OSJ, and there is now a presumption that a principal will not be designated and assigned to be the on-site principal, supervise more than one office, and FINRA says that when you're supervising 2 or more offices, it'll now be subject to scrutiny. So that's a little bit of a change. Inspections, they made some changes on the inspection rules that are going to be effective. OSJs and supervisory branch offices have to be inspected at least annually. Non-supervisory branch offices every 3 years, non-branches on a regular periodic schedule. But if a firm inspects non-branch locations on a regular periodic schedule that results in these locations being inspected less than once every 3 years, the firm has to document, why it was appropriate to go more than 3 years. And there's some other additions to that rule in terms of safeguarding funds and securities and the transfer of the transmittal, I should say, of funds. Changes there, and evaluating the independence of your branch inspection team. Some changes on the reviews of correspondence and internal communications. Well, it used to be it was only the New York Stock Exchange, but now there's a requirement to acknowledge customer complaints. It applies to all firms, and there's some very specific procedures now about how you capture, acknowledge, and respond to all written complaints, including electronic complaints. And they say that your system should be able to identify when emails were reviewed, the date of the review, that that certain of these electronically reviewed emails were escalated to the appropriate reviewer. And what they're saying is that electronic surveillance is a tool itself. And if you don't have the right electronic tool in place, that in and of itself is a supervisory factor that needs to be complied with or satisfied. They're looking at there's some transactions. I would say that just generally speaking, the final change, the big thing, supervisory control system. This new rule, and just like the old rule, says that a firm has to test and verify at least once a year that the procedures or supervisory procedures are reasonably designed to achieve compliance, and then report a summary of the test results to senior management. But some larger companies now have some additional requirements. Members with $200 million or more in annual revenue have to give certain formatted report to senior management regarding customer complaints and the internal investigation, and provide commentary on the compliance efforts in trading and the markets and anti-money laundering and things like that. So it's clear that these new rules can impact firms both large and small. Everyone has to amend some procedures, and the reason I mentioned it today was to make sure those of you that have compliance needs in this area that you are set for December 1. I mean, FINRA basically says that it expects to see a lot more documentation than it has previously required in the past that supports the, the firm's rationale for how it designed its procedures to achieve compliance. Particularly if the procedure, is different from the any FINRA presumption as to what an effective supervisory system is supposed to look like. So it's a good time to review all those things now if you haven't done so already. Those are my my comments. I hope we hit on a couple of interesting topics for people. Please let me know if you have any other questions or feedback. Next webinar, maybe I might follow up a little more on private equity, as I mentioned earlier. But I think my next webinar, November 12th, we just do so much collective investment fund work with advisors, plan sponsors, banks. What I'm going to do is try to give you a full 360 on collective investment vehicles. In other words, they really lay at the intersection of some securities laws, some banking laws from the OCC or parallel laws at the state banking level, and ERISA, and tax. I should have said tax in there as well. So we're going to have a really in-depth discussion on how collective investment funds are structured and regulated for our next seminar. And with that, I thank you very much for attending. Please send me any questions you have, and I hope you have a good day. Thank you.